Hello, everyone. Welcome to our April Mortgage Quality and Compliance webinar. We appreciate you tuning in and joining us this morning. My name is Samantha Gallagher, and I'm the Member Engagement Director here at the California MBA. If you have not joined us previously for one of these webinars, we hold them on a monthly basis, and we highlight a wide variety of compliance and quality assurance topics for the residential lending industry. If you are a member of the California MBA and you'd like to be part of our committee that comes up with the different topics and speakers that we present each month, please feel free to reach out to me and we can get you plugged into that pretty quickly. Before we get to our presentation this morning, I'd like to introduce Jen Jones. Jen is with Mortgage Forums, and they help facilitate our executive forum and the recently launched operational and compliance forum. We've invited Jen to spend a few minutes discussing the operational and compliance forum and an opportunity for you to get involved in this. So Jen, go ahead and take it away.
Hi, everyone. So as Sam mentioned, I'm Jen Jones with Mortgage Forums, and I just wanted to take a few minutes and let you know about the wonderful opportunity that is offered through the California MBA. 10 months a year, my colleague Deb Miagrossi, who unfortunately wasn't able to join this call, and myself hold a virtual operational and compliance forum. Each month, one of your peers is a host and the meeting, and we work together to bring a speaker or a focused roundtable discussion that goes over operational and compliance issues in the industry happening today. And then after that meeting with the presentation or the roundtable, you get to talk amongst your peers about ideas, offer support, opinions, or whatever you all choose to talk about. After this meeting, I'm going to send you my contact information as well as Deb's contact information. So if you're interested in joining this forum, and I'm also going to attach a little flyer that gives you some more details about exactly what the forum is. In the meantime, we have a current member, Paula Lever, on the call today, and I'm going to pass it off to her, and she's going to give you a little information about what she values from the forum.
Thanks,
Paula?
Jen. Hi, everyone. I am the VP of Compliance at CMG Financial, and I've been a member of the forum since sometime last year. And I just wanted to encourage people to join. We would love to have more members. More members means more great conversations, right? What I really appreciate is the meetings that we have are interactive. So we invite somebody to come speak to us, and it's very interactive. We're all on camera, stop, and we can talk about things, ask questions, and like Jen said at the end, we have a Q&A session where we can talk to each other about what issues we're experiencing and give each other advice. It's confidential. We actually sign confidential agreements so that we can have these conversations with each other, which makes it really good for us. We all need to be able to share information and, you know, stay in line and stay compliant and help each other with that. Deb also facilitates questions by email to forum members so that we can, even when we're not meeting for once a month, we can still email questions and have those discussions. So it's a great forum to be a part of. We'd love to see more members, so join. And I'll hand it off to Melissa to start the MQAC webinar.
Perfect. Well, thank you, Paula and Jennifer, for teeing that up. Good to always educate the membership in regards to other opportunities to connect, whether through this forum or other forums, but more information is always better, right? So thanks everyone for dialing in today. It looks like we've got a healthy group that are slowly trickling in to this, this webinar that we've got today. Excited to have the panel. Been working with them over the last week or so in regards to finalizing this deck, and really think that we've got a great host of information to give to all the membership here today. I'm going to go ahead and introduce just real quickly our three speakers that have so graciously given their time and expertise today. First, I'm going to introduce Alicia Briley, and she's with NContracts. And she's a regulatory compliance expert that focuses on lending compliance for the content team there at NContracts, and also holds the designation from the MBA as a certified mortgage compliance professional, also known as the CMCP. So she's going to go and give a great deal of information to us today in addition to 2 speakers that come from Crosscheck Compliance. And for those of you that don't know, Crosscheck Compliance is a nationwide consulting firm providing regulatory compliance, internal audit, fair lending, loan review, due diligence, litigation support. I mean, what don't you guys do? But anyways, a whole host of things. But today we've got 2 of their esteemed members. So first is Heidi, who's a managing director of regulatory compliance, internal audit, and fair lending at Crosscheck Compliance. And then we also have Ryan, who is a manager in the fair lending area at Crosscheck Compliance. So thank you again to all 3 of you for joining today and providing your expertise and putting this wonderful deck together. So I'll go ahead and turn it over to Alicia to kick us off.
All right. Thanks, Melissa. Thanks for the introduction. Hello, everyone, and thanks for tuning in. As mentioned, my name is Alicia, and I am with N Contracts. So today we're going to talk about harnessing your HMDA data, building the story that comes along with it. We're really going to be diving in deeper than the basics of reporting HMDA. We're going to look at it from some different approaches, the analytics portion of it, and really understanding your HMDA data, being proactive, preparing for your submissions and examinations, mitigating any risks, and really building that foundation to your HMDA story. And of course, submitting your HMDA LAR on time are all critical components for your institutions to do. And along with that is analyzing your data. And data analysis is essential to understanding the various risks from fair lending to compliance to credit to CRA to your compliance monitoring systems, which the regulators have said are going to be a big focus for examinations this year. They're going to be looking at your CMS. It's important to have your data analysis as part of that as well. Because when examiners review your institution for fair lending, as I'm sure we all know, they start with the numbers, right? So if you have any disparities, if you have any problems, if you're not lending appropriately, they're going to catch it in your numbers. And I think we can all agree that HMDA is complex, right? There's a lot of facets to it. Do you report? Do you not report? What do you report? There's a lot of complexities with it. So understanding those complexities and knowing where your institution fits within them is also important. And every bank faces fair lending risks. Every institution faces fair lending risks, right? And risks are managed with controls. And then controls influence the amount of fair lending risk that your institution's exposed to. Different roles may have different risk appetites and tolerances, so you need to work together and keep internally documenting what those appetites and tolerances are. This is going to help you be able to create escalation plans and know where to focus from a compliance perspective. Let's go to the next slide and talk about some best practices with data integrity and monitoring. Again, this is going to be a high level, not necessarily a deep dive into the data points and how it plays into the data integrity and monitoring, but your foundation really should include scrubbing your data for data integrity and monitoring. Again, this is going to be the foundation. It's also going to look at scrubbing and testing both before submission and after submission. You really should be doing data scrubbing both. When writing a story or doing a presentation, it starts here. It starts with data integrity. It starts with fact finding, with researching, with compiling your outline. And your data integrity and your monitoring are going to be a big start with that. And like I said, your HMDA scrubs really shouldn't just be done annually. Effectively managing your HMDA compliance, it really should be something that's done throughout the year. And this is going to be done through your periodic testing, your manual file reviews, your lending analysis. It's going to encompass various facets of monitoring. Now, one thing I want to draw attention to that we've heard institutions say that they do for monitoring is they do their HMDA scrubs where it's just them focusing on the HMDA edit checks. That should not be the only thing that you do as part of your HMDA scrubs, as part of your monitoring. And why? They're important, but they're not the only thing, because you're not touching your actual files. You're not looking at what data is on the documents in the file. Those edit checks are just going to check for the data fields and the codes matching what they should based on the formulas. One other thing that we've heard is institutions will do HMDA edit checks right before submission, which, yes, should be done, but really it should be done more consistently throughout the year. Because what happens when you're getting close to HMDA submission and all of a sudden you're running your checks and you have 2,000 validity edits, you're right before submission, right? That's nerve-wracking, and that adds a lot of extra stress before you actually go through and do your HMDA submission. Doing those validity checks and doing those quality checks and addressing them throughout the year is going to help make that easier right before submission, but it's also going to help you catch problems throughout the year that could be affecting other areas as well. Then you also want to make sure that you're reporting any of your findings, your processes to appropriate staff, build training off of it, but you also want to make sure that you have your corrective action taken as well on that. And it needs to be taken timely, not drawn out, and you need to be able to show that to your regulators. So those are all important high-level parts of data integrity and monitoring. Let's go to the next slide. So these are some common HMDA errors that you should be considering. You want to pay close attention to common HMDA errors that other institutions are having, but you also want to pay attention to common errors that your institution may be having as well. Some of these are going to be fields that also could affect any of your analysis as well. So failing to capture all HMDA reportable transactions. So you're over-reporting or you're under-reporting. Both of those are not good, right? So you want to make sure that you are appropriately capturing all of the appropriate loans, or making sure that you're not reporting loans that aren't actually HMDA reportable. You also want to double check your calculated fields. This is your rate spread, your DTI, your CLTV. And this is going to be something where you're going to have to look at the data fields that trigger the calculations, and also looking at the calculations themselves. The CFPB has the rate spread calculator. If you haven't used it, it does actually help when you need to do testing. So you want to make sure that you're running those checks and balances there. You want to make sure you're reporting the correct loan amount. A lot of times this is more of an issue that we've seen when it comes to your non-originated loans. Loan officers or your underwriters might be playing with the loan amount to see if you can get the loan to actually go through and be approved. But maybe the loan amount doesn't get put back to what was actually used to make the decision. So you want to make sure that your systems adequately reflect that. You also have income, making sure that you're reporting the correct income on your HMDA LAR. Again, this is also going to tie into your analysis that you do, especially around fair lending, CRA, redlining, all those analysis components that you do also go off of income. Your automated underwriting system, this one, your edit checks are going to catch to a certain degree, but it's not going to actually check to make sure that the most recent automated underwriting system is what's actually being reported. You want to make sure that you got your hands in that file and you're reporting what the decision was actually made from. Your purchaser type code, this one is a big one. And again, your edit checks are going to catch some of this, but you want to make sure that your purchaser type code that you're using for that investor is correct. And then you also want to make sure that you're reporting the correct purchaser all the way around. I've seen it before at institutions. I'm sure I'm not the only one. Maybe you've experienced it, where the loan is set to close. Your funding team goes in and puts everything into the system. Your system's now automatically going to trigger the purchaser code to be reported with that loan, but then the loan doesn't end up closing. The system doesn't always manually wipe out or automatically wipe out that purchaser type code when you change that status. So you have to make sure that you're not reporting a purchaser code when the loan didn't originate. Now, again, your edit checks are going to catch some of this, right? But it might not catch it early enough depending on when you do your scrubs. You also want to make sure that your action taken is reported correctly. Now, with this one of the big ones that I want to draw attention to is your non-originated loans for your withdrawn, for your file closed for incompleteness. Those two are big ones, or your approved not accepted, especially because withdrawals are a big focus for the regulators. They don't want to see a lot of withdrawals on your HMDA. So you want to go in when you're doing your scrubs and make sure that these are actually truly withdrawn loans. And if they aren't truly withdrawn loans, you have to reevaluate. You may have to go back to the drawing board, update procedures, provide extra training. So those are all things that you should be considering. And then also look at your government monitoring information, your loan purpose, and your occupancy type. Again, you may find other data points that have a commonality with errors or have systemic problems. So you may have to add more to your list, but those are just some to kind of get you started. All right, let's go to the next slide. Yep. All right. So remember, don't just focus on HMDA alone when building your story. Your HMDA data and the HMDA LAR feeds into other regulations. So fair lending, which is a big one, and it's really one of the main regulations that people think about when they think about the relationship with HMDA. Redlining, part of fair lending in a lot of ways. This is a huge focus from the DOJ. We've seen a lot of redlining enforcements coming up. When we've heard recent updates from them, is going to be a big priority. They're also going to be working with state attorney generals to put this up as a high level focus as well. So if it's important on their radar, it needs to be important on yours. The Community Reinvestment Act, there's maybe not a lot of banks on this call, so I'm not going to dig into that too far, but CRA and HMDA do tie together. HMDA is just a very small portion of it because you do have a lot of other considerations as well, but it is a part of it. By not understanding where your data is and where your loans are distributed, how you're impacting these communities, when you're not looking at how your demographic distribution is laid out, those can all be things where you might have a gap that's going to affect fair lending or affect redlining or affect CRA. And we're going to talk about how some of those data points that you should be looking at can aid in making sure that you're more successful with your analysis and ultimately your examinations throughout the presentation. Next slide, please. So HMDA Plus data, if you've been in the HMDA world since pre-2018 HMDA rule, you'll know that there's a lot of similarities, but there's a much bigger platform, right? You have more data at your fingertips. This means that if you have disparities or you have things that you need to look at a high level, you have more at your fingertips up front, and you don't have to go in and dig through your files. Back before 2018, when we had all this information, all these data points easier and more closely at our fingertips, you had to go into every single file and pull what their credit score is, pull their DTI, pull their LTV, anything that could affect that disparity, you would have to go in there and look. Well, now credit scores reported, DTI, CLTV, those are all things that are kind of right there, and you can better determine if it is actually explainable that there'd be that disparity, or if maybe you need to go in and do some more looking at it just to double check. That said, though, I'm going to tie back to data integrity. If you can't trust your data and you're not validating that the data that you're reporting is correct, even having this data at your fingertips isn't going to help. Remember, bad data in, bad data out, right? It also gives you an opportunity to do a deeper competitive analysis. How are your peers doing in the market? What are they doing? You can use public HMDA data. You can use your HMDA data, all as a part of this deeper competitive analysis that feeds into your strategic plans or your growth. Next slide, please. All right, now we're going to talk about some of the data fields to pay attention to. Some of these data fields as a part of your fair lending and your HMDA analysis that you utilize are back in the day from pre-2018 HMDA. However, pre-2018 HMDA or post-2018 HMDA data is going to really give you that bigger picture. And it can be used for risk factors. It can be used for your disparity checks. All those different things and your reporting can put a big focus on that. And underwriting here is a biggie. And this is where some pretty big risks can hide out. It can also be hard to track and connect the dots. With post-2018 HMDA fields, we have, like I mentioned, the credit score, we have income, we have CLTV, or debt to income, we have CLTV. And a main focus in these reviews is approval versus denial rates. And this is to determine if loans are being denied equaling on appropriate factors that are discriminatory. You can deny an applicant based on underwriting criteria, not on a prohibited basis, right? So this is going to help you look at that. So how can you as a lender address the disparities that are identified? So you can ask if the denial rates make sense. Does it seem too low? Does it seem too high? Or does it seem to be in a normal range? How does it compare to your peers? What has changed with your programs? Have you changed your underwriting policies? Is there anything else with your business model that has changed? How about anything related to COVID overlays? Those are all things to consider that might affect your approval versus denial rates. You also want to pay close attention to your policies and your procedures. Make sure you're reviewing them. Make sure that you pay close attention to any of those policies that can address any of those underwriting factors. Review any complaints that you may get, especially pertaining to underwriting. Remember, any exceptions made to the rule for underwriting should be tracked. You don't want them to become the rule, any exceptions, unless it actually makes sense for your business and it's documented. And then you may need to reassess with your lending teams too. Review your second review process for denials, if you have one, in order to assess what's being looked at. Are there any gaps? Is there proper documentation? Those things like that. If you don't have a second review process for your denials, then there is definitely a to-do takeaway there. You want to have a second review on those denials, especially to help with better understanding and making sure that you don't have any potential fair lending issues. You also want to look at doing overlap analysis, regression testing, those types of things, which we'll talk about later. Heidi and Ryan have a lot of really helpful information there and some images for you to see kind of what those analyses will look like. Make sure you are providing adequate training to applicable loan staff and that you're tracking the training being provided. Keep your board and committees in the loop, and you should really provide that training to them too, so that way they understand how the process works, what your staff have that they have to take care of, and then also in preparation for any examinations or findings or risk mitigation, you want to make sure that they understand where you're coming from. Reviewing denials is definitely a big one when comparing it to your approvals. But you also want to make sure to review your fallout as a whole. You want to look at those withdrawn loans. You want to look at the approved not accepted, the incompletes, and see if there's a high number of minority or LMI applicants that withdraw their loans or that are incomplete or maybe approved but not accepted, then what do the terms look like? You want to make sure that you're paying close attention to that. And regulatory agencies now have more insights into pricing information without asking for it. They can pre-screen financial institutions to look for outliers. They can target for fair lending examinations. There's a lot more at your fingertips, but there's a lot more at the regulators' fingertips as well. And post-2018 HMDA gives us more data points to evaluate regarding loan terms of the terms of the loan, including pricing, that can be disparity red flags. And loan level pricing is a lot more complex, which should be on your radar as well. And data points related to pricing, such as your total loan costs, origination charges, discount points, lender credits, interest rates, introductory rate periods, those are all new data points that are at your fingertips in relation to pricing. Then we have new expanded fields on loan features. So you can look at prepayment penalty terms. What loans have that? Do you have a high number of minority applicants that are being charged or being have a prepayment penalty term applied to it? You compare to your loan terms. Do you have a high number of minority applicants that are in 30-year mortgages in comparison? Is there reasons for that? You can look at non-amortizing loan features, so your balloons, your interest only, your negative amortizations. You can compare open-end lines of credit, reverse mortgages. Those are all things now that you can look at when you're doing your analytics. And pricing is one of the highest risks in the loan life cycle, but it's really one of the easiest to track. There aren't necessarily as much that goes into assigning a rate as there is for underwriting, theoretically at least. So how do you ensure consistent pricing? Your policies and procedures are an important starting point. You want to make sure that you're training your lenders or your applicable loan staff that are taking care of the rate portion of it. And then you want to make sure that they understand the correct way and the importance of pricing loans correctly. You want to make sure that they're using the best information reasonably available. All of these things are going to be what examiners ask for during examinations when they see a disparity. They're going to want to know what you're doing to make sure that the pricing is being done correctly. You should also be tracking any deviations to your pricing too. Pricing, like I said, it's one of the easiest ones to track, but that is one piece that I have seen and often experience gets missed, is those exceptions. There's not one system that you can track your exceptions. There's not a second review. There's not an approval process. You want to make sure if you allow for policy exceptions to your pricing that it's documented, when it's going to be allowed, and then make sure that you track it and you as compliance teams have access to that. Again, it comes down to being able to explain the importance of that to the appropriate staff, because they're going to be your first line. They're going to be the ones that are doing everything initially, and that's why they call it the first line of defense. They're going to be there for you as the foundation, and if they're doing it right and they understand the importance of it, it's going to help as the process goes along. You also want to look at patterns or practices in your disparities. Use your matched pair and your loan programs when it comes to your loan programs. You want to make sure that you're including the loan programs in your reviews as well. We also have more data around property information, like address, and property value. And with the address, it's a lot easier to do dot density analysis for redlining, whereas before 2018 HMDA, we mostly went off census tracts unless you really got into the weeds and assessed the address yourself. I don't want to go too far into that because I know that's kind of going to be a focus for Heidi and Ryan, but definitely something to consider there. And one sort of tangent I want to get off of, and it's not going to be a long one, I won't take up much time, is appraisal bias. We know appraisal bias is a big one that's going on right now. It's going to continue to be a big regulatory focus, and it's not going away anytime soon. We're seeing a lot with enforcement actions and everything else that comes along with that. This needs to be something on your radar when you're doing your analysis. And I've been asked a few times if you can use your HMDA data, or how can you use your HMDA data to help prepare for and kind of mitigate risks for appraisal bias. Really, HMDA would just be a small tool of that. You have address, you have all the things, you're doing your fair lending reviews. When you're doing your fair lending reviews, try to incorporate something around appraisal bias. Look at red flags when you're looking at your data points at a high level. Determine what makes sense for your institution, but really make sure that you've got a piece there that you can actually utilize to try and mitigate some of those appraisal bias risks. Like I said, sometimes you have to get in the weeds because the examiner is going to. You need to be able to explain what happened, the root cause, and the remediation. Sometimes it's a good thing to not have a disparity in your field, and that's okay, but you have to make sure that that data is right. All right, so I've given a bunch of information, but what tools can be used? How can you further assess where you're at? And you can do that by the testing, by mapping, and really analyzing that data. So I will pass it on to Heidi and Ryan now. So you can go, yep.
Great. Thanks, Alicia. That was wonderful. As Alicia said, basically, I mean, I think she gave a great overview of the processes that you want to make sure that you're doing to make sure that your HMDA data is accurate. Obviously, once you submit your HMDA data, you want to make sure that you're looking at that data for performance doing a performance analysis, right? Are there any pricing disparities, underwriting disparities, levels of assistance disparities? And so those are the kind of things that you want to make sure that you're analyzing and understanding to build your story. We also wanted to talk a little bit about how that might look and how beyond just fair lending, right? How else you might be able to use some of this data, right? I mean, is there a way to capture some of this data and use it for your business strategies, so things beyond just HMDA and necessarily fair lending. One of the first slides I have in here is really it talks about levels of assistance, but part of it is just really kind of taking that deeper dive and understanding some of the things that you're reporting compared to your peers. So if we take kind of a deep dive into this spreadsheet or this little chart in here, the first two rows represent the aggregate 2022 aggregate HMDA reporting, right? So the originated loan volume is 8 million. 52% of applications were originated according to the aggregate data, right? If you look a little lower, you'll see 15.58% was denied, 13.8% were withdrawn. That's always great information to have, and you want to understand where your peers fall and where you fall in comparison to that aggregate. So in this example for lender A, if you follow along with me here, I know the slide is probably a little small, but the aggregate denied percentage of total records is 15.58%. If I work for lender A and I see that my denied is 3.35, that's a lot lower than the aggregate. So I'm going to kind of have to, dig into that a little bit further. When I look at the next number, I see the aggregate withdrawn is 13.8%. So of all the HMDA reporters, 13.8% of the applications are withdrawn. And if I'm lender A, 29.18% are withdrawn. So just in looking at that, I can see, okay, how do we compare to the aggregate? I see my denieds are much lower than the aggregate, and I see my withdrawns are much higher than the aggregate. So that's going to, maybe raise some red flags for me to say, all right, do we have some issues here, right? Are we withdrawing more applications? Do we have borrowers withdrawing more applications than they should be? Are some of those really denied? Are we flip-flopping those? Are we reporting those wrong? Perhaps you really do have 29% of your applications withdrawn, and then that might actually lead to some other questions like, is there a customer service issue here? Are you following your policies and procedures consistently? Or are you ignoring people to the point to that, at some point they just withdraw and go somewhere else? So there's some value in knowing how your records compare to the aggregate data. Another example, lender B, approved not accepted is 9.5% compared to the aggregate total of 2.6. And again, denied is 1.97 compared to the aggregate total of about 15%. So again, where it varies significantly from the aggregate, you really want to ask yourself, perhaps what are we doing wrong? What are we doing different? Maybe our data's wrong, or maybe there's something, if the data is accurate, maybe there's something more to that, and we need to dig into that further. The second one here on the bottom, really I just wanted to highlight the race not available. In this case, 25% roughly for the aggregate data, and in our sample, lender C, it's up to 44, almost 45%. So that is very telling also, and the regulators are looking for that information, right? If you're not collecting, right, fair lending, all of this stuff, if you're not collecting the information, it basically, stops the process, right? If you don't have the information, you really can't move forward to understand what your lending patterns are. So in this particular case, with that 45% almost, you, as a lender, you should really ask yourself how, why is that happening? How are we collecting that information? Or in this case, why are we not collecting that information? And a lot of times what we see is maybe that's the online process, right? So that online application process, where in the process are you collecting your monitoring information? Are you doing it up front? Are you waiting until, after many of your applications fall through the process, and therefore you're not able to collect it after the fact? So again, really just looking at your data and analyzing your data compared to the aggregate data can really provide a lot of information, in addition to, understanding, if there's any significant disparities in your particular data sets. All right, we're going to switch to the next slide, please. And then Ryan, I think we're going to turn it over to you.
Yeah, thank you, Hetty. So a lot of good talk, right? So we're talking about all this data integrity issue, right? Because I believe, as Alicia said already, garbage data in, garbage data out, right? So one of the great things about HMDA data, or at least I think it's great, because as a data guy, is that there is a lot of this information out there for you to not only assess yourself, but also to look at yourself, against other peers. So you have that internal assessment, and then you have that external peer assessment as well. Something that we like to do a lot is ranking yourself against our peers. So we know that the CFPB likes to use a peer group that is essentially kind of a formula. So within a particular geographic area, your peers are everybody with 50 to 200% of your application volume. Well, we can go and we can start digging into that, and then looking in that particular geographic area, ranking yourself. What is your percentage of loans in majority minority census tracts as compared to all those different peers? How do you compare to those peers? Are you on the high end? Are you on the low end? How do you shake out there? But it doesn't just have to be limited to fair lending or redlining when you're looking at majority minority census tracts. The 2018 post-2018 public HMDA data file, a few of the fields are scrubbed, but a lot of those fields are there to use from a business perspective as well. You can look at particular types of census tracts. So it doesn't necessarily just have to be majority minority census tracts. You can look at majority Black or majority Hispanic census tracts, or you can look at what borrower races are. How are you reaching Hispanic borrowers? Are you reaching Black or African American borrowers? And then you can even dig into that further. So you can say, okay, maybe in a particular geographic area where we're struggling within majority minority census tracts. So let's go in and we can drill down, and we can look at the types of loans that are within that. Maybe we have a couple of peers who are doing really well in those majority minority census tracts. With the data that's available, you can go out and you can drill right down to exactly what types of loans those peers are doing in those census tracts. You know, is it because they're doing a lot of FHA loans there? Are they doing a lot of VA loans there? Is it a specific type of loan purpose? Is it look like the ages of those loans? If you go and break down the ages, does it look like maybe, you know, it's a lot of younger people getting loans? Maybe, you know, your competitors are doing a better job at getting those first-time home buyers than you are. So a lot of that information is available and out there for you. And you can take those peer groups and you can really dig down into them and look at them and see, you know, where maybe those peers are having a little bit more success than you are, or you can look and see, you know, where you're having more success than your peers to maybe figure out, you know, why you're successful in one area, but maybe not another. And then the other thing you can do with peers, because all that information is available, is to put things on a map. And so Heidi's going to talk a little bit about that next.
All right, that next slide, please. All right. So as Ryan said, right, having all of this information and being able to compare yourself to your peers, it provides valuable feedback. So this was really just 3 samples of some types of mapping. The first one here is just majority minority census tracts of a particular area. You'll see the darker purple is higher majority minority census tracts. The lighter purple, you know, fewer minorities, pink and the light. So in this case, if I'm looking to see how we're doing in the majority minority census tracts, we're going to focus on lending in these purple areas, the darker purple areas. Peer lending, institutional lending, I have these here side by side for the same area. And, you know, right off the bat, if based on this heat map, there's a lot of things that I can see. Blue for the heat map are areas where we aren't making a lot of loans, that nobody's making a lot of loans. You know, the lighter green, yellow that we get to all the way to red are more higher volumes in loans. So if we could switch to that next slide, I can kind of take a deeper dive in on this next slide. We basically highlighted some areas here that are, you know, of interest, I think, at least in this example. So the far right here is the institution in our sample. Then we have our peer lending data in the middle. And then again, the majority minority census tracts highlighted over on the left. When you see your lending plotted like this, you can really look at it and analyze it and understand where you're making your loans, where aren't you making your loans, and then use that data strategically. How do you increase your loan penetration in certain areas? Maybe that's a strategy. Maybe that's training loan originators. Maybe that's hiring loan originators. It helps to first understand where you're making your loans and then really being able to use that to make those decisions as far as, you know, how to improve your business. In this particular slide sample, again, I would call, you know, your attention or my attention to that when I looked at this, there's a purple dot up in the top right. Basically, if you look at the institution, there's a big purple dot, that same purple dot in the middle one, the same purple dot on the left. There's no lending happening there, right? So that, of course, would be curious. It looks like it's a high minority area. What's causing that? Why is there no lending happening? If it were just me and my peers were making a lot of loans there, I might be even more concerned. The other thing that this might be, though, is it might just be that there's something in that area that is, you know, isn't conducive to loans. Maybe it is an industrial park, you know, a business, commercial industrial park. Maybe it's a park, right? Maybe it's just a park. Maybe it's an airport. So really understanding what is in your market area also can be seen and highlighted in some of these maps as well. This particular one also, you'll see the institution on the right. There's a lot of blue and you know, looks like some yellow in the middle area. These, you know, kind of highlighted it with the boxes here. If I look at my peers, though, they're doing a much better job really penetrating these majority minority areas, right? We see a lot more yellow, a lot more red. So if I'm in the sample institution here, I'm going to look at this and say, okay, why aren't we when our peers are able to make loans in these areas, right? Strategically, what do we need to do differently, perhaps? Or maybe we just need to tell the story, right? Maybe we don't have a lot of ranches in this area, and maybe that's part of the answer here. If I follow this down a little bit, where there are some arrows highlighted in here. It's a little hard to see on the slides, but clearly I do have a little hot spot on the bottom left of a sample institution where it does look like we are, in this case, getting better loan penetration. The peers are doing a lot better. They have more red spots, so to speak. But if I look at the actual map that talks about the census tracts itself, I can kind of see that there's a highway that goes through that area, and to the west of that highway, was dark purple, so majority minority. To the right of that highway is more the lighter pinks, and so not majority minority areas. And therefore, are we doing a better job in the non-minority areas, and we're not doing as good a job in the majority minority areas? And so really, again, just taking a step back, looking at your data, being able to map your data in these heat maps, overlaying the census tract and what's making up the census tract of the market area. I think this provides, valuable information for anybody that wants to do this analysis, both from a redlining perspective, but also really just a business strategy perspective as well. What can you do differently? What should you be doing differently? Again, I'm kind of mentioned talking about, training mortgage lenders, hiring mortgage lenders, marketing, outreach, things like that. And so really just wanted to kind of point out some of the things that you can do with a heat map comparison. I know Ryan has a bunch of, on the next slides, a bunch of other comparisons from a chart standpoint. He's definitely the data guy, so I'm going to turn it back over to Ryan and let him go through some of these charts that he has here.
All right, thank you, Hetty. I want to be cognizant of time, so I'm gonna kind of go through these a little bit quick, but I can, of course, if there's questions at the end about any of these, I can certainly touch on those. So the first slide I'm going to talk about here is looking at your market volume and risk. So first of all, obviously figuring out which geographies, if we're talking about redlining still, is which geographies do you have the most risk, and how is your volume changing year over year within those geographies. Once again, this is mapped right now for majority minority census, or for overall market share. So how is your lending going up and down? How is your market share going up and down? Because kind of the theme of this section is that obviously your lending doesn't exist in a vacuum when we're talking about it from either a strategic standpoint or from a compliance, fair lending CRA standpoint, is that your lending, it exists, but it also exists in the broader market with what your peers are doing, with what the aggregate's doing, with what the market factors are year over year. And so it's important with a lot of your analysis is, and especially if you're a smaller institution who has smaller volumes, is that to remember that a lot of your analysis is going to be subject to variation within that data. So you're doing your statistical analysis, but depending on what your sample sizes are overall, or within a specific geography, or within a specific subsection of your data, is to be really cognizant that you don't want to overreact based off of 1 year necessarily, especially on those lower sample sizes, because there's always going to be variations and fluctuations within your data. So we can jump on down to the next slide, and I'll talk a little bit about some more performance trending. So once again, this is just talking about looking at your data over multiple years. What this slide is showing is it's showing our lender institutions percent of total applications and loans from majority minority census tracts, and comparing that to aggregate lending and peer lending. Once again, just looking at how those fluctuate year over year. We can move to the next slide pretty quickly here, and I can show a little example of something that you kind of might see. So in this example, our subject institution is in yellow. And as you can see, the bars and the yellow bars and the yellow lines, the bars are just loans, the lines are applications. They're staying pretty steady over 2018, 2019, through 2021. So you might say, hey, we're continuing to do, about the same amount. We're doing a good job. But once again, you don't exist in a vacuum. Over that time, you're seeing that the peers and the aggregate are doing more and more of their loans in those majority minority census tracts. More of their applications are from majority minority census tracts. And so even though you're kind of continuing with a steady performance, you're starting to create a disparity between yourself and your peers, which is what regulators are certainly interested in. The other thing I just wanted to point out here for those of you as you're doing your trending is that in 2022, that's when the reclassified census tract geographies, they were updated and reclassified. So depending on if you're looking at specific markets, you might see some kind of wild swings in your data as you go from 21 to 22. So it's important to recognize that you might see some wild fluctuations, but those fluctuations might be due to some underlying factors within the census data. So that's just something to keep in mind there. And then we can go to the next slide, and I'll give my short little math lesson here on. So a lot of what you'll see, not only for redlining, but this applies to pricing and your underwriting analyses that are going to be done by the regulators. We're going to talk a lot about statistical significance, and especially when it pertains to redlining and strategies for curtailing any redlining disparities. One of the questions that I would get when I was working at the mortgage company or the bank, right, was, well, how many more loans do we need? Well, that's a really tough question because there's a lot of factors that go into how many more loans do you need. And a lot of those factors some of those factors are completely out of your control as well. But the important thing to note is that they're often going to cite that you have statistically significant disparities. So sometimes not everybody is clear on what exactly statistically significant means. But all statistical significance really means is that it's a measurement that's trying to quantify whether the difference in your performance, say whether that's between you and your peers, or whether that's the performance of declines for African American applicants versus white applicants, whether any variation between those two data sets is likely due to random chance, or if there's some other underlying variable that could be causing it. And so, for example, I have some examples here that go into some of the factors that can impact some of that statistical significance. One of the things is sample sizes. So lender A is in doing more applications and has a peer group that has a lot more applications as a result in their market. And so even though they have kind of the same lending as lender B, the same, they're doing the same amount of their loans in the majority minority census tract as lender B, the peers are doing the same amount, the difference between that is the same amount. One of lender A has a statistically significant disparity where lender B doesn't. So the size of your populations, once again, is going to impact that statistical significance calculation. And then lender A versus lender C, in this case, the disparity, the difference between what lender C, the percent of loans that lender C has in majority minority census tracts versus the peers is actually double. So from a 3% difference to a 6% difference. But because more loans overall are being done in those majority minority census tracts, that actually doesn't lead to being a statistically significant disparity. So there's a lot of factors that can go into that calculation. And so it's hard to say, we need to do X many more loans, or we need to do, Y many more applications. And so that can often lead to, some difficulties when you're trying to make those strategic decisions. And so you've got to kind of, feel that out in some ways, right? How big is that disparity? Are you currently at a statistical significance? Are you currently not in your disparities? And then kind of address those as needed. So I will now turn it back to Alicia, I believe.
All right. Well, thank you both. That was a lot of really good information, and the maps are definitely a good tool. And I do have to agree with you, Ryan. You said you're the data guy and you might be alone for liking HMDA, but you're not. I'm right there with you. I don't know why I do, but I do apparently. So I can definitely relate. Let's talk about some ways that you could utilize HMDA data outside of just fair lending. So HMDA and fair lending, like I mentioned earlier, they really go hand in hand. A lot of time when you're talking about fair lending, you got a HMDA included in the thought process or vice versa. So even though we're going to talk about HMDA from a little bit different of a perspective, there's things that you can take from what we're going to talk about on this slide, you know, and utilize it throughout your fair lending. You can use what we take on this slide from your fair lending reviews. So you can look at your program development, assessing your market, both markets you're trying to get into and then markets that you're currently in. You can look at evaluating efficiencies. You can uncover potential issues. So staffing and capacity, compliance management systems, technology. You could look at building relationships, what community groups are out there that you can have that relationship with, provide home buyer seminars, look at what realtors are in the area that you could build relationships with. Not anything that's going to cause a RESPA issue. Disclaimer, make sure you're cognizant of that. But if you can connect with realtors and do home buyer seminars for clients that they have, and different things like that, that's going to ultimately open you up to more potential business, which is going to help you on the analysis side, right? Like you kind of saw on those maps. And we talked about during the data analytics. You know, those are all things that you can look at. And then Heidi, did you want to add anything to that thought process?
No, I mean, I think you covered it, right? I mean, HMDA data, obviously, the goal of that is really fair lending, right? And so there are definitely other uses to it, although the primary is fair lending and CRA. As Alicia mentioned here with this slide, I think that covers, you know, there are definitely other areas that you can use that when you're assessing your markets and trying to understand where you're lending. I think really, if I take a step back as to all the things that we talked about so far today, right, is really understanding what that data tells you. And that's what the regulators are doing. We've seen the regulators do more and more analysis on HMDA data. I know many of you actually might have received a letter recently from the regulators talking about property addresses. And we know they're obviously analyzing data differently. They've gone back a couple years now. And they're analyzing data differently all the time, and they continue to improve and enhance the way they analyze the data. And as lenders, we have to continue to improve and enhance how we analyze that data as well. The last thing you want is for the, you know, the regulators to find something in your data and for us to be, you know, considered, you know, found off guard, right? Caught off guard with, you know, with that information. So we as lenders want to make sure that we, you know, fully understand it. Again, this is, you know, some of this stuff is very complicated. Luckily, we have people like Ryan and Alicia here that know the data inside and out. But there are a lot of partners that you can work with as well. If you don't have the staffing internally to do some of this analysis, there are a lot of partners out there that can help you dig into that and understand what the data is really telling you, and perhaps what the data is going to be telling the examiners too.
Yeah, absolutely. And software and technology in and of itself, both from the regulator standpoint, third parties, the consulting firms out there, there's a lot more, kind of like Heidi mentioned, at your fingertips now compared to where there used to be. And I remember when I had to do it manually, all the data analytics. I'm surprised I'm not 100% gray. So it's definitely take advantage of what you can out there that's going to help, because you're going to be able to expand a lot further. I think we have just one last slide, but I know we're at the top of the hour, and it's just, if you want to move to the next slide, it's on section 1071. What better way to harness your HMDA data than to look at the regulations that cross over. So if you haven't looked at the small business data collection rule, make sure to, if you do any type of small business lending, there's a lot of resources out there. Utilize what you do now currently for HMDA and see what you can take from it that's going to work for a Section 1071 component. And that is all I will say on this very busy slide. And I'll pass it back to Melissa and Samantha.
Perfect. Well, I'll just say thank you real quick. I know we're 1 minute past. So just thanks again. A lot of great information, Alicia, Heidi, and Ryan. And yet again, another part of our lives in which data drives a lot of analysis, decisions, and can really, I think, what you guys have done an excellent job of doing is showing how, you know, we used to think HMDA data was like, okay, we file it and don't look at it, but we definitely need to look at it from a fair lending perspective, and this industry has known that. Very heightened awareness of that in the past 5 to 10 years, but I would say now too, what better time than for fair lending HMDA data people to go and talk to the business and to product and everything else, to also look to, you know, to Heidi and Ryan's point of opportunities maybe that maybe your institution isn't implementing that maybe others are. And what better way to do that than to look at the data. So thanks again, team, for joining, and I'll turn it over to Sam to wrap it up.
Thank you, Alicia, Heidi, and Ryan. That was such a great presentation. We appreciate your time and knowledge. We do have a few questions that have come in. So if those of you who want to stay on and listen to these questions or get some of your questions addressed, please feel free. But if you need to hop off, we definitely understand that as well. We have 2 that have come in that I think we should just address really quick if you all are okay with that. The first one is FFIEC states indicate that AUS used to evaluate the application. If a loan has an AUS but never gets to the point of a credit decision, does the CFPB expect the AUS to be reported if pulled, but the loan did not make it to the point of credit decision? Right. Not sure if anybody wants to take that one or understands that.
So I think I'm trying to remember for the AUS and the transaction chart, because it says on the data points chart.
So maybe what we could do is take some of those more detailed questions and we can get back to the audience separately, right? So I was going to say, I mean, I know that I'd have to look at the technical requirements again myself. I think it is that you're supposed to only report it if the AUS that you relied on. But if you don't rely on it, ultimately, what the answer is. But
Yeah, there are some technical requirements with that, and the data points chart and the HMDA Getting It Right guide are really going to tell you when you should look at that, when you should report it, and how you should report it with that piece of it. But if it's all going to depend on those components.
Okay. So the next question: how should wholesale lending be accounted for business that do both retail and wholesale lending?
Can you repeat that one more time? My audio for a second.
How should wholesale lending be accounting for business that do both retail and wholesale lending?
So I can address that a little bit. So if we're talking about from a data analysis perspective, or when you're looking at your HMDA data, what I will often do is I'll look at everything as a whole. So if I take all of your lending and put it together, how does that look? And then I will also then take a look where I break that out. So I will look at your application channels, and if those application channels are specific enough or different enough, right, where you're looking at, you have different underwriting guidelines, or maybe the way you're sourcing applications there, right, is obviously different. And so what I'll do is I'll look at that all together as a whole, because the CFPB or whoever your regulator is probably going to look at it as a whole. But then I will also split that out and look at those two. So if you have like your retail and your wholesale, I'll look at those separately as well, to see how they look on their own, essentially.
Thanks, Ryan. So we have one more that just came in. If a trust is on the deed, oh, we got a few coming. Hold on. If a trust is on the deed of trust and not on the note, does the trust count as a borrower?
So yeah, I think we've got,
Yeah, we can go
we're
back.
stumping us a little bit here on some of the
Yeah.
details.
Yeah. Yeah, that's a stumper one.
Okay. We'll answer one last one. Does paying of a PACE loan count as a refi? The PACE loans put as a special assessment tax. A lot of questions coming in.
Yeah, I think, like I said, Samantha, maybe it's best if we
Yeah,
get a
we can-
summary of the questions that we can
Yeah.
look at and maybe provide back
Oh,
to.
sure. Yeah, we can
Some
do
of
that.
them.
Yeah, and we have all the speakers' contact information in the slide deck as well. So those of you who have questions and we haven't been able to get to them, you can reach out to them directly. And yeah, I can send our speakers a summary of the questions like you suggested, Heidi. But yeah, thank you to those that were able to join and stayed on for that extra few minutes. Thank you, Alicia, Ryan, and Heidi for your time. Melissa, great job as well. Thank you, everyone, and please be sure to tune in next month. It'll be again on the 4th Thursday at 11 a.m. Pacific time. So thank you all for your time. Have a great rest of your day.
Thanks, everyone.